not saying you need to be aware of everything, but if you pick a market, specialise in a few, which I'm sure Ian is going to talk about shortly, picking a few markets rather than absolutely everything, then effectively you want to look at the data for those markets alone. You don't need to know everything, just the bit that concerns you. So, there's a correlating relationship. Does anybody know why there's a correlating relationship? I recognise some familiar faces. Anybody? Very, very close, sir. It's because Canada is the largest exporter of oil to the United States. It makes up a third of their total economy. So it's huge, sorry, total exports rather than economy, my apologies. So a third of their total exports in a single year. So the two correlate together because volume flow, capital flow to Canada goes down if oil gets cheaper. And as the major exporter, if the CAD rises, it becomes more expensive for the US to buy the oil. Everybody with me? Brilliant. So, one last one. This is adding a third stage, effectively. Still the CAD, still WTI. Can everybody see the counter-correlated relationship with the dollar? Right, so, considering that I've covered this, does anybody want to take a guess as to why it's counter-correlated? Anybody? Simon? It's counter-correlated because, sorry, go on.
You said
Sure.
Canada exports States.
So
Because it's priced in the dollar, so
yes,
therefore,
sir. Yeah.
yes.
So these two correlate together because of exports. The counter-correlation is because oil is priced in dollars. And you find the same counter-correlation with Brent as well because it's priced in dollars, even though it's pulled out of the North Sea. Right, one last one, and then we'll move on. I don't know how long I've got left. So, okay. I feel like I'm talking really fast, but my apologies. Do shout if you want me to slow down. So one last one, Australian dollar against iron ore. Considering we just talked about Canada, and we talked about the fact that Canada is effectively, the Canadian dollar is effectively linked to WTI because it's a primary export of WTI, or sweet light crude at least, to the US. Anybody want to take a guess as to why iron ore would correlate so heavily with the AUD?
Exporter of
Major,
Sir?
major
Yeah. You're all absolutely right. Iron ore is Australia's primary export. Again, we're looking at, I think in the case of Australia, we're looking at 22% of exports. And everybody says gold is so important to the AUD. I fundamentally disagree. There is correlation, but it's not as strong as iron ore. The reason for that is actually, comparatively, in terms of total trade value, more iron ore is exported. And it actually employs more people in Australia as well. My lovely partner, her cousin, I think, owns an iron ore mine, and they can't make it, they're just making it hand over fist. And he employs thousands of people in the middle of the desert. There's nothing else there. Australia's economy is driven by raw materials, and as such, iron ore makes up the largest part of that. So we get this lovely correlation, and often we get the turn within the AUD before we get the turn within iron ore. Because again, iron ore in this market, iron ore futures, priced in Australian dollars. So, again, we're seeing that turn. We're looking for an advantage. We're looking for where the economy can offer us some advantage. But we're also looking to protect ourselves from sudden spikes and sudden exposure. Everybody with me so far? I hope. Right, so harnessing economic data. This is where it starts to get a little bit less complex, hopefully. But this is every major data release, everything that happens that's of any real importance to the market for the US dollar. Down here, I don't know if you can see, but it's the USD CAD in purple, AUD USD in orange yellow, USD yen in red, Euro USD in blue, Pound USD in pink. And this is the average pip move. So it's the number of pips on average a release moves one of those currencies. This is hand-built by our team. The only place you will find this is Bloomberg. And the equivalent data on Bloomberg is, in my opinion, just about unbeatable. It's so complex. But this data shows you over 10 years worth of events, the average number of pips it moves one of those markets. Right, so then we've got the same thing for the pound. The same thing. You can see BOE interest rate decision. You can see the pound, weirdly, the thing that moves the market that moves the most on an interest rate decision for the pound Australian dollar. I didn't ever have guessed that. When I was shown this by my analysts, I just didn't believe them. I didn't go back and check. Right, so from there, we're looking at key pieces. So this is all CPI inflation.
Andrew, I'm just going to ask a question on behalf of some of us that are beginners here. So we've talked about all the different currencies, and there's all sorts of fundamentals of news effects that have an impact on the price. So you want to study several of the currencies.
Yeah.
Which currencies, currency baskets, would you say would be the better to study to start with as a beginner, to say, I'm going to track 2 or 3 currencies to begin with, and try to get to know as much as I can?
What I'd start with is the things you know. And a lot of people say start elsewhere, start with the big 3, start with dollar-based currencies. Pick what you know. If you're Norwegian, take a look at the Norwegian currency, the Norwegian krone. If you're American, use the US dollar in your favour. If you're British, use the pound. You know that economy better than anybody else. You live in it. You watch the news in your language. You see what is going on. It is much easier to pick 3, which is always our recommendation. Start with 3, know those 3. Get them as interlaced as possible, so 2 with a dollar in it, and maybe 1 with something else in it. Try or 2 with the pound in it, and 1 with something else in it. So that you've always got, you're not completely reliant on that one instrument moving. But reduce the number you're looking at, specialise in those, get to know them well, understand them well, and you will know this stuff inside out. Our traders knew this before we produced it. That's why we produced it. Because our traders sat around going, oh, that averagely moves the market by this much. On average, I find that CPI makes the pound move, the pound AUD move 40 pips, or 45 pips. There we go. 45 pips. Pound yen, weirdly better than for trading the CPI inflation than the pound AUD, which is great for the inflation, great for the interest rate. Our traders knew this. What we had to do was go away and prove it, and that's a whole different thing. So you are looking at those, just specialising in a few, there's lots of it out there. I run a huge team who specialise in doing it day to day. That's their jobs, and they provide that information to us. All you have to do is find the stuff that works for you, specialise, learn what you want to learn. Don't spread yourself too thin. I mean, a good example, one of our traders wanted to trade a FTSE for the first time. So the floor over there decided the best thing to do was to limit his position size. He could have traded 78 a point, limited into 10 because he'd never traded it before. Don't experiment with real money. That's not what it's there for. Real money is there to make more money. Experiment on your demos and trade properly on your system, on your live account. That's what it's for. Longevity is everything. And that's what I'm talking about here. Know your markets, know the risk, know where spikes can come from, and you'll round it all off nicely, and you will get to a consistently viable position. Right, so, again, more of... Yeah.
Can I ask you a question?
Yeah.
Okay, I understand that fundamentals are
Yeah.
when you speak to technical analysts, he says everything has been actually priced in. So,
Trust me, bear with me, I'm coming to that. So more of the same, trust me sir, I will be... So Federal Reserve interest rate decision. Here we go. This is our currency sentiment calendar, our risk and sentiment calendar, where we, on a Sunday, go, right, okay, this is the way it looks. This is where the sentiment is likely to drive the market. Got to look for it technically. Technicals always come first. Our job is to provide framing for the market. But what we've got here is we know that an event can cause significant positive or negative sentiment. So here we have an interest rate decision. put a nice big red warning on it to make you aware of when it's going to be dangerous and when it can hurt your account. And what do we get? Down, 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 back. It's not all priced in. That's a 15-minute chart, and you can see it moved from 94.8 down to 94.4. Actually 94.3 there.
That is if you're trading or short term.
Even if you're trading long term, that will translate as, what's that? 200, no, 400 pips. Are you running a stock with 400 pips there? I mean, that's the thing, is the spike alone, even if you're swing trading, if you've got a 400 pip stop, you're only just going to survive that. So it's about balancing the two, knowing your risk, taking your profits, reassessing trades. It's, technicals will lead the way. They are primary. But if you add in just a little bit of economics, you can avoid the spike that stops you out of a perfectly good trade. Or, in this particular case, trading upwards, and if you're, well actually, it's not really trading upwards on the 4 hour. I haven't got a longer time frame, I'm sorry. But effectively trading upwards, if you're in a swing trade for a couple of days, that's going to go in your favour. But at the same time, you want to be out up here. So by knowing the news exists, you can be monitoring it closely enough that if you, even if you are in the same direction, it's going to take 2 or 3 days to get back to that point. Back up here, it's going to fill that gap first, and then it's going to do it again, in all likelihood. So why not know the news is there and get out right at the top where you made the most money. Reassess when it comes back down, go in and do it again. Does that answer your question, sir? That yes, it is priced in to a certain degree, but not all of it is priced in. We estimate that only actually about 63% of price movement is pre-priced into all this. The rest of it is uncertainty. So it's effectively, we don't know the outcome, therefore we cannot hedge in. And I was talking to a hedge fund manager the other day, who was saying that he only actually started to hedge his position between 4 and 10 hours beforehand. So within the day, because in current markets, it's nearly impossible to hedge your position one way, with Brexit screaming on one side, and the President of the United States screaming on the other, a slowing China, and still unstable Japanese economy. There isn't enough stability to allow the big money, the institutions, to find their positions. And the reason he was talking to me was because he was asking our analysts to do 5-hour pre-analysis, because we do it 3 times a day when he opens, and he wanted something in the middle of that, specifically so he could start to hedge his positions. Right, so Japanese retail sales. Love this one, because this is a particularly old example, but I love it because it looks like this. Japanese retail sales. Most people would think it's not the most important figure. But, as you can see, 15-minute chart, that is a significant change in the trend. Again, we're looking at, I want to be out here, wait for it to pull back, have a little look. Because the trend looks great, it looks fantastic. But if you can take this, reassess on the pullback, and then go again, why not make twice as much? Twice the trend. So, from there, we'll round off with institutional processes. I've got a question over there. We'll round off with institutional processes. Event calendars and forecasts. Just have a look. That's all I'm asking. Just keep one up. If you don't want to use the ones that are free as a free member of the RTCT, then use the ones that are available on Fineco. Use the ones that I highly recommend at investing.com or Forex Factory, or use ours because they're great, or use the ones that are on Fineco. From there, create a watch list. If you've got certain trades, have a look. If you think something's coming, you can wait. You don't have to take it there and then. You can wait a bit and wait for the setup. Patience is a virtue in trading. So I'm told by our head analyst, because to be honest, I'm not the most patient man on the planet. Neither is our head forward. Baskets analysis. Take a look. If you haven't got access to the baskets, and you don't want to join the RTCT for free, then go and have a look at the bond market, which will tell you roughly the same thing. And on Fineco's platform, they've got all the majors. You can go and have a look at them. It's all there to be looked at. Then market monitoring. Again, reassess, take a look at your trades, see where the markets are, learn your markets, understand them. Trading confirmation, I'm not going to talk about that because Ian's going to do it better than me in about half an hour's time. Select the most viable pairs. Again, know your markets. Pick the things that are going to work for you. Pick the things you understand. That data doesn't have to be a big scary thing. It just needs to be awareness of the data and an understanding of the markets that work for you. Basic understanding as well. So from there, just a nice little daily plan, which is roughly the way our traders trade. We look at the baskets, then we check the major announcements, the sentiment, analyse the pairs, always top down, institutional timeframes at least. If you don't, take a look at the months at the start of the week, and then your weekly, daily, T40, 60, use that process top to bottom, always, because that way you're breaking down the risk. For example, this lovely gentleman here was like, is it all priced in? If you go top to bottom, you can see that pricing in. You can see the proportion of that pricing in. And then from there, use a simple strategy. I'm not going to talk about that either because Ian will talk about that in brilliant detail. And set alerts. If you are a busy person, use alerts. They're brilliant. They're available on Fineco and they are fantastic because if nothing else, you can say, I think this area is going to be a worry. So, and I'm busy today, so I'm going to set it 10-15 pips below that. Then it'll ping. Got enough time to go and get a coffee and take a look at my phone or take a look at my laptop. It buys you the time to understand the market when it suits you, rather than letting the market rule you, which is what we do, because that's our job. And then psychology, I'm not going to cover this in detail because I've run out of time, but I will just say, make sure you're in the right mindset. I'm not sure who I said earlier, but we had a trader the other day that had an argument with his wife, which I know doesn't sound like much, but lost 2.5% in a morning. Not trading again all day, not trading for the rest of the week, because he's compounded that argument with his wife on top of then losing money. And if you do that, if you're not in the right mood, you are guaranteed to lose money. If you're not in the headspace, you would not go out into the street with a load of pound coins, throw them on the ground, and then decide not to pick them up because you're in a bad mood. Same with trading. It's your money. Look after it. So be in the right frame of mind. Obviously, trading is much more complicated than that, but I think it illustrates my point of it's your money. Keep it by only trading when you're in the right frame of mind. And that's it from me. Good traders never ignore bad news. Thank you for your time. Any questions? They can be, yes. I'm sure if you ask them.
As long as you allow us to share.